We want to keep it on the markets right now and bring in our next guest, David Nelson, Belpointe Chief Strategist. Hey, David, thanks so much for joining us today. And really want to start just by getting your reaction, or maybe lack of reaction, on the markets front, given this red hot inflation number that has just come in. I love that you say flat is the new up.
Bottom line, the core is a little hotter than expected, maybe below the whisper, but 7% for 2021. That's a monster number, and the Fed will have to maintain the course. Coming into today, 76% of economists were looking for a March liftoff for rates. I don't expect that to change. I think really the bigger question is, how is the Fed going to deal with the balance sheet? And they have a lot of choices here. They could let it slowly run off, or they could be more aggressive with it. I think they're going to choose the option where they're going to probably let this balance sheet unwind over the next decade. But for me, as an investor, clearly the worm has turned. This is a different market than 2022, than 2021. Investors want some food on their plate in the form of earnings, cash flow, and/or dividends this year.
David, good to see you and your suspenders back in the show. So let's talk about inflation and market expectations, because, again, we're rallying today in the face of the highest inflation numbers we've seen in decades once again. Is this because investors are buying into the idea that prices have peaked? Do you believe that? And what's the impact going to be here on earnings? You know, one of the fundamentals that drive market action.
There's all kinds of inflation, and certainly things like commodity inflation, that can turn around in a heartbeat. All you would need is just a hint of a slowdown in economic activity. But wages, that's sticky, and it's going to be very difficult for companies to take back during the next downturn, take back some of those wage gains that workers have gotten right now. So I think it's a real challenge. I think this time, this is different. This is different than what we've seen in the past. You have to go back to the 1970s to see anything like that. And for Powell and the FOMC to actually turn course and abandon the word transitory, they understand that this can really creep into earnings, and it's going to force investors to rethink their portfolios and concentrate on companies that have pricing power that won't be impacted by this.
And then want to bring your attention to earnings, which kicks off. You have some real zingers in your note, and you say beware of stocks with no E in the PE. Well, banks are kicking off earnings season this Friday, as usual. What do we expect to see from them? Because they have been minting money amid higher rates, and as lending has increased as well.
That's really the key challenge here, and that's really what you've seen over the last couple of months, this kind of turn in the NASDAQ. I'm not worried about the Apples and the Microsofts of the world. You can make the case that Microsoft is a bit rich at 32 times forward earnings, and if there's a correction, it'll come down to 27 times. But you got too many companies out there that are trading at 30 to 50 times sales. They have no earnings. They haven't had any earnings since they started. So even if they correct 50%, the PE ratio hasn't changed. Nothing's changed. The price divided by zero is still zero. And that's where I think investors are going to start to change, because in almost every sector, even in technology, you can dig down and find companies trading at less than a market multiple and growing their top and bottom line at double-digit rates.
Now, in addition to financials, David, you also like energy, one of the big winners from last year. I'm curious where you see opportunity for investors within the energy space this year, and how much more of a runway do we have to go here?
I don't think it's just about the commodity. I think part of it is political. The administration's push against the energy complex, keeping them out of lucrative fields, they've kind of gotten religion, and they're pulling back, and they're not going to drill. They're not drilling as much. And when you stop drilling and your costs go down, free cash flow goes through the roof. And that's what investors have started to recognize here. Now, if there's a big retrenchment in the price of crude, it's going to hurt these stocks. But I think the demand will be out there. And I think any rational view of moving to a greener society has to include increased fossil fuel production until those other alternative forms of energy can scale.
And then I want to ask you about supply chain issues, because, we hear such conflicting news. On the one hand, we hear like the Baltic Index shows that shipping prices are coming down, but there's still a bunch of ships in the ports in LA. And then now we have this added wrench of China having more COVID cases surfacing at Ningpo, one of its biggest ports, and then also in one of its manufacturing hubs where they make, chip conductors. So what sort of wrench does that throw into the mix as far as taming inflation?
It's big. And in some cases, there's maybe not a lot that we can do about it. It's a real challenge. Jay Powell commented on it. The president has commented on it. And I think all the parties are trying to do everything they can. And there's an even larger dynamic because you look at a country like Taiwan. Taiwan is certainly a risk. China is still an adversary in every sense of the word. And it's an imperative to bring these supply chains home. Certainly for semiconductor manufacturing, it's not just good business. It's a national security imperative. So I look outside the space. I look at semiconductor equipment manufacturing. I look at a company like AMAT. There's one of those retro tech companies that from the dot-com era trading at less than a market multiple, yet growing the top and bottom line still at a hefty pace.
And I want to talk about outside of equities here for a moment, David. I'm wondering if the bond market's looking any more attractive to you, especially in an environment where we're going to see higher interest rates. I mean, while yields are rising there, they're still pretty low, right? We've got the yield on the 10-year below 2%.
I'm certainly not investing in bonds right now, but it's a big challenge for the market because at some point in time, we're going to have to get out the 2018 playbook. And when the 10-year starts to get meaningfully above 2%, and I mean somewhere around 2.5%, that's when institutions like insurance companies and pension plans are going to start to de-risk. They're going to start to fund future liabilities with something other than a risky asset class like stocks. They've been dragged into the stock market because there's no place to be. When they can get back into fixed income at a reasonable price, they'll do it.
All right. Well, we will have to leave it there, but I am really starting to get concerned about the health of consumer because the price of everything is going up. Food, gas, clothes, what we're paying for rent, mortgage rates up at their highest level for 30-year fixed mortgage as well. David Nelson, thanks for stopping by today, Belpointe Chief Strategist.